Good morning, everyone. Can I check that you all can see the screen and you can hear me? Hi, good morning. Can you type something in the Q&A box if you can see the screen and you can hear me? Okay, okay. Thank you for your replies. I got several replies. Okay, so since everything is working fine, we'll start the webinar now. So first, we'll talk about industrial REITs, where we published a report last week. We're maintaining equal weight on industrial REITs. And then for the 9 months or 3/4 of this year, sector occupancy has been stable, but the rental index has trended lower during the year, except that each successive quarter, the rental index decline is getting smaller. I'll show a chart for that in a subsequent slide. From demand side, it looks fragile as manufacturing and export data are moderating. For industrial REIT sector, we maintain our view that rental bottom likely to be delayed to 2019 and generally negative reversions to persist for at least the first half of next year. So this table is a summary of the JTC data for third quarter 2018. The left half shows the rental, right half shows the occupancy. So you can see for rental wise, generally it's red arrows, which I said just now that rental has been declining. Occupancy, you can see there are some greens. So I said also occupancy this year has been relatively stable. So the positives for the quarter is that sector occupancy has remained stable, and in fact for third quarter is the highest year to date. There's a tapering supply in 2019. For negatives, as I already said, rent still coming down, although it's declining in smaller steps. The other negative is that for the bellwethers, Ascendas REIT and Mapletree Industrial, there was a lower occupancy for their Singapore portfolio. And then in terms of rental reversions during the quarter, it was a mixed bag with a negative bias. So the range roughly was +5 to -10. That's roughly the range for the industrial REITs Singapore portfolios. Key takeaways from the quarter. These are some of the qualitative things that we hear through our conversations with the REIT managers. So firstly, is a slower growth to be expected from trade tariffs, but there are also opportunities. The opportunities, for example, are in Singapore and Vietnam as companies relocate out of China. Having said that, relocating out of China is not a new trend. This has been talked about already. The original catalyst was wage pressure in China. It's no longer as cheap as it used to be for labor. And so this added tariff has added a greater sense of urgency among companies to relocate out of China. Second thing is that for Singapore-wise, market condition, they're still saying is challenging, partially also because of concerns over trade. The industrialists are also uncertain about their own outlook. For that, we also still expect the rental reversions to be negative for at least 2 more quarters. Industrialists are hesitant to commit to new leases due to the escalating landscape of trade protectionism. And also, customers are cautious over placing new orders, and this has a cascading effect on the entire supply chain. So investment action, as I said before, we're maintaining equal weight. The theme of tapering supply in 2018 has largely run its course. So the scorecard for the sector is that this year so far, out of the 9 months, occupancy has been range bound over the last 3 quarters and has remained stable. But rental index has trended down, but in smaller increments, and negative reversions to persist. Yeah, so what will make us turn positive? We want to see evidence of higher rents and broad-based recovery in occupancy. So far, occupancy has been stable, but not exactly picking up. And then what will make us turn negative is a further moderation of manufacturing and export data and reflooding of supply of industrial space. So this is showing the industrial REITs under our coverage. We have 2 accumulate and 2 neutral. Okay, this is unchanged, top down from previous quarter, unchanged from previous quarter. We still favor the business and science park properties and high-tech, high-specs buildings. Tactical bottom-up stock pick. This is the same as last quarter as well. Capital DC has better than average capital management. So this is exactly the same as the last quarter, but the numbers in the table has been updated already. So what you see is that we have focused on the 5 indicators relating to capital management. That's gearing, weighted average debt maturity, weighted average cost of debt, interest coverage, and the percentage of debt that is hedged at fixed rate. So for those where the REIT is better than the average, the bottom here is the average. For those that's better than the average is colored green, and those that is worse than average is colored red. So as you can see, Capital DC REIT here is the only REIT that has all the 5 metrics which are better than the sector average. So this is in relation to the rising interest rates. So in that sense, probably Capital DC REIT will be the better insulated and better prepared compared to the rest of the peers. So this is a summary for the REITs under our coverage during the recent results season. We kept our ratings unchanged for all 4 of them. However, we had to lower the target prices by between 1.4 to 8.5%, except for Capital DC REIT, where the target price was unchanged. So for cash, the yield is now about 8%, and we think that that's pricing in the risk that's coming in 2019. That is so for now, 2018 4th quarter, there's minimal risk, but in 2019, there's 28% of the portfolio up for expiry and renewal. Among these 2019 expiries, some of it is master lease also. So for 2019, actually, in summary, there are 3 key risks. That's the non-renewals of this 28%, and then secondly is the master lease conversions, which would impact the distributable income as well. And then there's the negative reversions for the spaces that get renewed. So in view of the risk, we've actually also raised the discount rate, but kept the long-term growth rate the same after the results. For Sanders REIT, Singapore portfolio experienced some lower occupancy, but silver lining is that there was positive rental reversion on a blended basis for the Singapore portfolio. For their total portfolio, Sanders has got exposure in Singapore, Australia, and UK. So for the total portfolio occupancy, it was higher to 90.6, and this was aided by the inclusion of the UK portfolio, which is effectively 100% leased. So the WALE for A-REIT is 4.3 years, is healthy and higher than the sector average of 3.8 years. For Keppel DC REIT, data center demand remains robust. So for 2018, the manager has achieved its $2 billion target AUM, and the manager has articulated that it intends to maintain the pace of acquisitions in 2019, although no target for the AUM was given. WALE of 8.5 years is the longest among industrial REITs, so this means that they have good visibility on the income for compared to the other REITs. And then, as I showed just now in the table, Keppel DC REIT is the best in class among the industrial REITs in terms of capital management and interest rate risk management. Next is Mapletree Industrial Trust, which we believe it has unattractive valuation now. The Singapore portfolio had some weakness in terms of rental and occupancy. Average rent has come down and occupancy also has come down. But on the whole, distributor income has been mitigated by the inorganic contribution from the portfolio of the data centers that was acquired in the US. During the quarter, they also resumed the distribution reinvestment plan, and this is to strengthen the balance sheet and fund development projects. The current yield spread for Mapletree Industrial Trust is at its tightest ever, and that's why we think that it's expensive at the moment. This chart is showing the chart on the left is showing the industrial sector occupancy. On the right is the rental index. So you can see that occupancy has remained stable in the 3 quarters of this year, and in third quarter, occupancy is the highest for the year. Rental index continues to trend downwards, but the difference is getting smaller. This is showing for factory. So here, multi-user factory occupancy has made a new low. It continues to trend down, and factory rental index seems to be stabilizing. Business park occupancy also remains stable, but the rental index appears to have peaked. Warehouse occupancy, this is a bit of a positive surprise. It's improved both quarter on quarter and year on year. And then the rental index is also shows signs of stabilization. This chart on the right shows the supply pipeline. So there's about 518,000 square meters of space expected to come on stream in the fourth quarter this year, and that potentially increases the existing stock by about 2%. And then for 2019, about 1.28 million square meters of space, which would increase current stock by 2.6%. So average annual supply and demand of space in the last 3 years was 1.6 and 1.2 million. And so you can see that next year, 1.28 million lies in between. That's slightly higher than the historical demand, but lower than historical supply. So you can see that supply is tapering. This is the... Okay, sorry for the typo here. This shouldn't say June 2018. So for this chart is showing... Oops. Okay, this chart, this slide is showing the manufacturing and export data up. There was a dip in manufacturing in September. That's minus 0.2% year on year. That is actually this point right here. This is not a major surprise, as for all the preceding months, actually, we were already seeing signs of weaknesses. And then PMI has trended down during the first 10 months. And you can see here, electronics PMI has come down quite a bit. And then for electronics production, that is this light blue line here. You can see that for 2018, the range in 2018 here is lower than when it was in 2017, where it was quite high up here, and compared to here 2018. So you can see that this aspect is already slowing. And then for exports wise, the thing to highlight is right here, Nordex for electronics has remained in contraction for the first 9 months of 2018 and also up to October. This is just a summary of the results for the quarter. You can take a look at it in more detail in your own time from the report. And then this is, as usual, I show this comparison. This is a historical comparison over the last 1 year of how the sector has fared in terms of the price to book and the yield. So this is as of November this year. And then if you go back in time, so right here at the bottom right is November last year. If you look on the number on the right, which is the yield, you can see that from 7%, it has trended to 7.3. So the yield has increased. And then for price to book wise is 1.13 last year, and now it's 1.03. So you can see that the valuation wise is getting cheaper and yield has expanded. So this could be a reflection of increasing yield aversion, risk aversion from investors. And then, as usual, this chart will show the current peer relative valuation compared to a quarter ago. So on the left is as of November, and then on the right is as of August. Okay, again, sorry for the typo here. This actually, as you can see, normally larger market capitalized REITs tend to trade at the bottom right corner here, meaning that investors are paying a premium and accepting a lower yield compared to the smaller size REITs. The other thing the most noteworthy change is actually Viva. It used to be there, but it's no longer here. It has been acquired by ESR REIT. So you can see that ESR REIT, the size of the bubble also has increased compared to a quarter ago. Okay, now we move on to Alvin, who will talk about SHS Holdings.
Thanks, Richard. This is Alvin. So we'll talk about SHS results. So we downgrade to accumulate with a lower target price of 24 cents. Last target price was 29 cents. As you can see, revenue has increased 43.5%, but the downgrade was mainly due to two factors, which is the substantial delay in the Bangladesh solar project and the higher operational expense, higher than expected. And these expenses are due to the ramping up of the modular business. So for a quick recap, SHS has three business segments: engineering and construction, which consists of steel and modular, and they have a solar portfolio also. And the other segment is corrosion prevention for the marine and offshore sector. So admin expenses higher 16.1%. Other operating expenses increased 58.5%. And this is due to the redevelopment of the heated office building for the engineering and construction segment. Finance costs also increased 500% due to higher bank borrowings for the factory and office. So going forward, we expect modular to continue its contribution towards the engineering and construction segment, while the structural steel business remain in a challenging environment. So key risks includes further delays in the construction of the project. Anticipated earnings for this project is 4 million a year. So we have trimmed down our target price in light of the delay, 3-quarter delay. So with that, I'll move on to Paul to talk about Golden Energy.
Yeah, hi. This is Paul here. Guangzhou is not in today. Today is off for a marketing trip. But anyway, I'll just speak on his behalf. Yeah. Okay. Golden Energy released its results. I think the production performed well. It was up 65%. But what was the negative has been lower coal prices. They still maintain their output target, but I think the worry right now is that there has been a slowdown in ASPs. The most recent number is about $30+. I think what has happened is that the China has imposed curbs on imported coal, and this is kind of suppressed coal prices in general. China is actually curbing the coal imports until the end of this year. In another development specific for gear is that they made a 20%. They acquired 20% stake in this Australian listed coal miner, Stanmore. Our recommendation is still a buy, but at a lower target price for Golden Energy. I move on to gear. To Geo. For Geo, it was a bit negative. It was negative for us. About production rose 15%. It was actually below our expectations, and also they've actually guided for lower output in terms for the full year. I think we've revised down our guidance for production from 10 million. What was positive for them was that there was a deal done with Macquarie Bank. There were 3 parts to this deal. Firstly, they got a life of mine offtake agreement for their new mine, the new TBR mine that they just acquired. The other positive is that, and they've also the bank also took a 5% stake in Geo at the price of 29 cents. And also, they've also subscribed to some warrants with an exercise price of 33 cents. Obviously, all these are above the current market price of 20 cents. For us, the reason why the share price is corrected is that they've number one, they've guided for lower production for this year. And also, the coal prices have, of course, also been corrected recently. And that's the reason why the share price is corrected. For the outlook, like mentioned, they've cut the production from 10 to 7 to 8 million. According to the company, they're actually holding back on production due to the weak price. And of course, the big overhang right now is the coal import restrictions out of China. Okay, next move on to Minyin on Q&M.
So good morning. So moving on to Q&M. So this time around for this quarter, we've downgraded Q&M to neutral with a lower target price of 51 cents. And this is mainly due to quite a few negatives this quarter. So firstly, there was a muted clinics business growth. So revenue growth from both clinics and distribution is at 0.4 and negative 2.7 respectively. So despite having more dental clinics this year as compared to last year, we have 89 this quarter and 86 last quarter, the revenue growth from clinics actually grew quite gently as compared to last year. And this is mainly because of the dampened patient demand for Q&M services because of the tightening from the governments on CHAS and the Pioneer Generation Scheme. So patients are unable to claim as much as they could last year, and quite a huge chunk of Q&M's revenue is dependent on such claims from patients. And also Q&M is in a net debt position of 63 million this year as compared to 52 million last year. And this is mainly due to share buyback of 4.7 million and dividends of 10.5 million. and majority of their debt is from the 60 million 3-year term loan to repay the MTN that expired this year in March 2018. So recall that in the first few quarters of this year, Q&M gave guidance that they will open 10 new clinics in Singapore and 10 new in Malaysia. But as of November, Q&M only expanded by 3 clinics year on year and 3 Q on Q. So as we approach the tail end of the year, it seems that Q&M's aggressive expansion plan at the start of the year might fall short for both Singapore and Malaysia as well. But do note that as of November, they have already signed agreements to open 3 new clinics and 4 new clinics in Malaysia. So the positive for this time round is that the gross profit margins for their respective businesses, dental side and also the distribution business, have reverted back to their pre-acquisition levels. So this is because of the deconsolidation of Idetel and Outsing. So in this time round, this third quarter, revenue for the 9 months is purely from Q&M. Idetel and Outsing's revenues have already been deconsolidated and is recognized now in the share of profit from associates. So other updates that the management shared with us this quarter is that they are intending to expand to a new business line called education. So this is because MOH is in the process of implementing a new regulations in 1 to 2 years' time to require all dentists practicing aesthetic procedures to obtain a certificate of competency. So Q&M is positioning themselves to be accredited CPE college, to be a teaching college for dentists, to issue these certificates for MOH new regulation. And they have also announced that they are exploring the use of artificial intelligence in dental scans and also x-rays. So previously, AI is only used in the heart and brain for ECG and EEG diagnosis. So Q&M is exploring this area to do AI for dental procedures as well. So for the outlook, we are still cautiously optimistic about the expansion plans in Singapore and Malaysia. And post-consolidation of its major revenue drivers from China, the group is still stepping up its regional expansion in Singapore and Malaysia. So our investment actions to downgrade to neutral with a lower target price. This is because of the more moderated pace of clinic expansion, as well as lesser CHAS claims made by patients due to government tightening measures. So we lowered our FY 18 to 19 revenue and PATMI by 18 to 32% and 10 to 14% respectively. We also reduced our PER to 25, and this is in line with peers average. So moving on to the banking sector, this is just a brief note on the talk we went to in SGX for Wave Money. So to give a brief outline of Myanmar's banking ecosystem, Myanmar has only 4 state-owned banks, 24 local banks, local private banks, 13 foreign banks, and 12 mobile money providers. And in comparison to Wave Money, they have 36,000 Wave shops in Myanmar, spread across 289 townships. So Wave Money belongs to the mobile money providers category. So as compared to the banks who have only 3,000 ATMs and 2,000 bank branches, Wave Money has 36,000 Wave shops. And most of these ATMs and bank branches are not even in the areas that the locals need. So before Wave Money came into picture, there's only 4 main options for individuals to send money back to hometowns. So it's either they travel back themselves, ask for a favor from friends and family to bring the money back, or they ask bus drivers that's going back to the towns to pass the money to their relatives, or they use hundis. So the yellow figures are as of March 2016, the percentage of people using these options, and the orange figures are in August 2018 after Wave Money came into picture. So you can see a huge decline in the old inefficient ways of sending money back to their own hometowns. So what is Wave Money? It's basically a mobile financial service that provides users with the option to send money in a safe and accessible manner via Wave shops and using a Wave account on their users' phones. So you can send money from one location to another, send to one user to another, and also pay merchants using Wave Money. So it started in 2016 October with 36,000 agents. And right now they have 5 million active users in Myanmar. And they have already achieved cash flow break-even in September this year. So the Wave Money ownership structure is majority owned by FMI, and then it's also owned by Yoma Bank and Yoma Strategic, and also Telenor. So how does Wave Money work? For the money transfer, an individual who wants to transfer cash will have to provide the mobile number of the recipient to the Wave Money agent at the Wave shop. Then the recipient, once they receive an SMS notification, they can head to any Wave shop to ask the Wave agent to verify the transaction ID and then to get the cash over from the Wave agent. And the second way that Wave Money works is by payment between individuals, just using their mobile numbers, like our DBS PayLah. It works the same way. And also merchant payment is like our GrabPay, where you just scan a QR code and you can pay the merchant. So this is the chart for the revenue growth for Wave Money. So you can see the revenue grew by more than 20% every year, and they've already achieved cash flow break-even this year. So for the outlook of Wave Money, we believe that it will not limit the platform to just financial services and payment services. They're actually experimenting to expand into areas such as cinema tickets, food delivery, merchant payments, donations, and QR codes for its Wave shop. And they also introduce pension payments through their platform as well. And they're also going to move into micro lending with the role of an introducer. So despite increased competition from the banks and the established telecommunication companies, Wave Money's distribution network is more than 10 times the number of ATMs in the whole Myanmar's banking system. So they have already penetrated quite well into Myanmar. And the trust that has been cultivated between the locals and using Wave Money has already been cultivated, and the locals trust Wave Money to part their cash with. And also the spiral network effect, where as more users adopt this platform, it will attract even more agents and vice versa. So this creates a continuous virtuous loop of linkages and transactions. So that's all for me. I'll pass on to Edmund to tell you more about US Weekly.
All right, thank you, Min. So right now I'll be covering the US market outlook. So the manufacturing new orders for durable goods last week was released, and it failed to meet the consensus, and it fell 4.4% from a month earlier in October. So although the figures seem to suggest that there is a slowing momentum for manufacturing activities, but this is mainly due to the large decline in the new orders for the transportation equipment. So if you exclude transportation from the figures, then the new orders will have increased 0.1%. Existing home sales has also risen for the first time in 7 months. Contract closings has increased from the prior month as well. However, sales were still down 5.1% from a year earlier, and that is the biggest drop since 2014. So this means that demand seems to be stabilizing at a lower level as available properties become less scarce. However, this weakness is likely to continue because there's higher mortgage rates, and with the Feds still going to increase their interest rates. So for the week ahead, some of the indicators that is going to be released will be the GDP growth rate and the personal income. One of the key highlights will be FOMC minutes, which will suggest whether there will be an increase in the interest rates for December. Another key event that's going to take place will be the start of G20, and a lot of people are looking at the Trump and Xi summit. So right now we'll look at the recession indicators. So the REITs index has been confirmed to reach the threshold of 27.7 in February, but has since dropped. It increased after the midterm elections to about 20, 21, and it is currently still rising, mainly due to uncertainties in the market because of the trade war. The S&P 500 has also dropped below its 200-day moving average in October. But if you look at the charts, it has actually dropped below the moving average a few times this year, and there was a sharp correction within a month. So all in all, we can say that the recession indicators are indicating that the economy is currently healthy. So last week, it was requested by the clients for the individual PE valuations for the FANG stocks. So first, we look at Google. You can see that it appears to be fluctuating between the average line and -1 standard deviation for the past 5 years. So right now, currently, is neither overvalued or undervalued. However, if you look at Facebook, it has reached a new low and has fallen below its 1 standard deviation and is still trending downwards. So currently, it is undervalued. Whereas for Apple, it is relatively stable for the past 7 years, and it doesn't seem to be changing as well. As for Amazon, it's currently trending downwards, and yes, since formed a new low since 2011. However, with the we are predicting that the Amazon Web Services is likely to drive the growth for Amazon. As for Netflix, it's currently around its average line, so it's neither overvalued or undervalued. That is all from me. Now I'll pass my time to Jie Yuan for the China weekly musings.
Thank you, Edmund. As for China last week, PBOC released a new document on October 22nd. It's about first strengthening for financing for private enterprise and the technology companies. The reasons why it's important is the first time the PBOC put quotas for loan quotas to private-owned companies. Secondly, they set the green channels for private enterprise for note financing. Also, there will be more credit spots for companies. So we are seeing the government still focus on helping private enterprise to finance. For company recommendations, or Hong Kong research teams downgrade the Chinese medical systems because of the new medical policies. They believe it will affect the price of the medicals. So they downgrade earning per shares for 0.74 at 2018 and 0.81 at 2019. For Air China, because of the because of the oil price increasing and the exchange rate, they also downgrade Air China's to hold. They put the P ratios at 14.2 at 2018 and 9.3 times at 2019. We think because if we look at the price of the China stocks, it's all lower than the average PEs. So you should look more on stocks which have the which have the policy spots and government spots. For this week, we will look at the G20 meetings. Also, we are waiting the China government has set the date of the fourth panel sessions. Because of on the meetings, there will be more policies regarding the reform and open up. I will move to the report for the Philips weekly musing.
Thanks, Mike. I'll move on to just the Singapore Weekly. In terms of the macro for last week, I think the key one was probably, apart from the macro data out there, was some comments by the New York Fed governor, just that the interest rate rise is not on the preset cost. So okay, I'll discuss more later. But anyway, in terms of Singapore macro, there were some CPI numbers, but it's within the MES expectations of 1.5 to 2. So unless we see something materially outside of this 2% or even 2.5 in 2019, don't expect anything aggressive on the MES. In terms of GDP, I think everyone has already seen it. I guess the key is that there's a deceleration, obviously, in the third quarter, and it was even below the advanced numbers and even what was the expectations for the market. In terms of some sector news, we did meet up with some tech companies. I think what we've seen is that there's been a major collapse in orders for November. I think what they've mentioned is even month on month, some orders actually dropped almost 40%. What has happened is that with the trade tariffs, any production now or any products that ship out of China now will probably arrive only in the US in January, and again then this batch, if there's nothing changes, this batch of products will incur the 25% tariffs. So as a result, the whole supply chain is actually on standstill. The whole electronic supply chain has actually de-risked or actually destocked. So everyone's very cautious, not building up any inventory, and that's why it's partly due to Apple, of course, and also partly due to the trade tensions. So what is worrying is maybe the fourth quarter numbers for most of the electronic companies may actually be softer than expectations. Now, maybe only in the first quarter we might, depending on the Xi and Trump discussion, we could see some market pricing in the bottom probably in the first quarter. In terms of a tactical bet, again, we still expect some positive outcome from the Xi and Trump meeting. Again, that we've mentioned it a few times before, so I won't dwell on it. The key thing for this, and also another thing to monitor this week will be the Powell speech in New York Economic Club. As you recall, in the 3rd October, the market has reacted, at least the bond market has reacted to his hawkish comments that interest rates are a long way from neutral. So everyone is hoping for some dovish comments from Powell in his 28 November speech in economic and at the Economic Club. In terms of our tactical bets, again, with the continuous rise in interest rates, and what we're looking for is at least stocks stocks with dividend growth. Some of these even include SGX. SGX is benefiting from, for Singapore market, obviously they benefit from domestic flows. But when it comes to derivatives, SGX do benefit from global flows. So, and of course, the other sector that's actually growing that we could see growth in dividends will be the banks and selected REITs like CCT. So in terms of the week ahead, the two key things will be, of course, the G20 summit and the Powell speech at the Economic Club. Okay, I think that's it from us. If you have any questions, please type them down. Thank you. Just on the PowerPoints, we usually upload it in Stocks BNB. Yeah, you can get it from there. Or I think you just email us your you can just email to our admin or research. We will send the slides to you in a PDF version. I think it's a bit too big for this week. Yeah, just send an email to us. The research, or we will send a copy to you, the PDF version. Yeah. Okay, one question on the 2019 market outlook seminar coming. Yeah, we'll probably hold 2019 outlook in January. Once we fix the date, we will let you know in our weekly webinar. Yeah. Thank you for the question. Yeah. Okay, we just wait one more minute. If there are no questions, we will just end it. Yeah, thank you. Okay, you for the email, just email to research@phillip.com.sg if you want the slides. Yeah. I repeat, just type research@phillip.com.sg. Thanks. Okay, if there are no other questions, we would like to end it, and thanks everyone for participating. Thank you.